Have you ever walked into a store and seen shelves packed with products that nobody seems to buy? Or maybe you've noticed huge clearance sales where companies slash prices by 50%, 70%, sometimes even 90% just to get rid of inventory. At first glance, it seems like bad management. Why would companies spend millions of dollars producing products they can't sell? Shouldn't they simply make less? Surprisingly, it's not that simple. In fact, some of the world's biggest companies regularly struggle with excess inventory. And in many cases, having too much inventory is actually the result of companies trying to avoid an even bigger problem: running out of stock. Today, we'll explore why most companies end up carrying too much inventory, why it's so difficult to avoid, and what businesses do to manage the trade-off. Let's start with a simple question. Why do companies hold inventory in the first place? The obvious answer is to meet customer demand. If a customer wants to buy a product today, the company needs inventory available today. Nobody wants to wait weeks for a common household item, a pair of shoes, or a replacement phone charger. So companies keep inventory on hand. But inventory isn't free. Every product sitting in a warehouse represents money that has already been spent. The company has paid for raw materials, they've paid for manufacturing, they've paid for transportation, they've paid for storage, yet they haven't received revenue from the customer. In other words, inventory is cash sitting on a shelf. The longer it stays there, the more expensive it becomes. That's why inventory management is one of the most important functions in business operations. The challenge is simple to describe, but extremely difficult to solve. Carry too little inventory, and customers can't buy what they want. Carry too much inventory, and the company ties up cash and increases costs. Finding the perfect balance sounds easy. In reality, it's almost impossible. The biggest reason companies accumulate excess inventory is uncertainty. Businesses don't know exactly what customers will buy tomorrow, or next week, or next month. They can forecast demand, they can analyze historical sales, they can build sophisticated models, but no forecast is perfect. Imagine a company expects to sell 10,000 units next month. Should they produce exactly 10,000? If actual demand becomes 12,000, they'll run out of stock. Customers may leave and buy from competitors. Revenue is lost. Market share is lost. Customer trust is damaged. To avoid that risk, many companies produce more than the forecast. Maybe 11,000, maybe 12,000, maybe even more. Most inventory problems start with that simple decision. A company chooses to protect itself against stockouts, and that protection becomes excess inventory when demand turns out lower than expected.
There's an old saying in supply chain management: forecasts are always wrong. That sounds harsh, but it's actually true. Forecasts can be useful. They can be highly accurate, but they can never predict the future perfectly. Consumer preferences change. Weather changes. Economic conditions change. Competitors launch new products. Social media trends suddenly appear. A product that seemed destined to be a bestseller can become a slow-moving item almost overnight. This is why inventory planning is fundamentally a game of probabilities rather than certainty. Companies aren't trying to predict the future. They're trying to make the best decision with incomplete information.
Another major reason companies carry too much inventory is long lead times. Let's say a retailer wants to sell winter jackets in November. They can't wait until November to start production. Many products are manufactured months in advance. Factories need schedules. Raw materials need to be ordered. Products need to be shipped. International transportation can take weeks or even months. As a result, inventory decisions are often made long before actual demand is known. The further a company must look into the future, the greater the forecasting error becomes. And the greater the forecasting error, the higher the risk of excess inventory. This is especially common in industries like fashion, consumer electronics, furniture, and seasonal products. By the time the company realizes demand is weaker than expected, the inventory is already sitting in warehouses. Then there's the fear factor, and this is where human behavior becomes surprisingly important. Many inventory decisions are made by managers. Managers are evaluated on performance, and in many organizations, running out of stock is highly visible. Customers complain, sales teams complain, executives ask questions. Everyone notices. Excess inventory, on the other hand, is often less visible in the short term. Products quietly sit in warehouses. The financial consequences may not become obvious until months later. As a result, some organizations unintentionally encourage overstocking. Managers become more afraid of stockouts than excess inventory. When given a choice, they order more inventory than necessary. Not because they're careless, because they're trying to avoid immediate problems. This behavior appears in companies of every size, from small businesses to multinational corporations. One of the most important concepts in inventory management is something called safety stock. Safety stock is extra inventory intentionally kept as a buffer. Think of it as insurance. Companies know forecasts are imperfect. They know suppliers can be late. They know transportation disruptions happen. So they keep additional inventory to absorb uncertainty. This is generally considered a best practice. The problem occurs when safety stock levels become too high. If uncertainty increases, companies often respond by increasing safety stock. When uncertainty becomes extreme, inventory levels can explode. A good example occurred during the global supply chain disruptions of the early 2020s. Many companies experienced severe shortages. Products were delayed, factories shut down, shipping became unreliable. To protect themselves, businesses increased inventory purchases dramatically. Some companies ordered far more inventory than normal. Then supply chains recovered, demand slowed, and suddenly warehouses were overflowing with excess inventory. What was originally intended as protection became a major financial burden.
There's another reason excess inventory happens. Businesses often receive discounts for buying larger quantities. Imagine a supplier offers two options: buy 1,000 units at $10 each, or buy 5,000 units at $8 each. The second option appears cheaper. Many companies take the discount. The problem is that lower purchase costs don't always mean lower total costs. If the company struggles to sell those additional units, storage costs increase. Cash remains tied up. Products may become obsolete. Eventually, the inventory discount can disappear entirely. This is one of the classic mistakes in inventory planning, focusing only on purchase price while ignoring inventory carrying costs. Technology has improved inventory management dramatically. Modern companies use forecasting software, machine learning models, advanced analytics, and real-time inventory tracking. But technology hasn't eliminated the problem, because the core challenge remains uncertainty. No software can perfectly predict human behavior. No algorithm can guarantee future demand. Technology helps companies make better decisions. It doesn't remove risk. And that's an important distinction. Many people assume inventory problems exist because companies lack data. In reality, even companies with enormous amounts of data still face inventory challenges. The future simply refuses to cooperate. So what do the best companies do? They don't try to eliminate inventory risk completely. Instead, they manage trade-offs. They improve forecast accuracy. They reduce lead times. They monitor inventory health regularly. They segment products based on demand patterns. They balance service levels against inventory costs. Most importantly, they recognize that inventory is not just a supply chain issue. It's a business decision. Every inventory decision represents a choice between customer service, cash flow, and risk. There is no perfect answer, only better trade-offs. Here's the key takeaway. Most companies don't have too much inventory because they're incompetent. They have too much inventory because predicting demand is incredibly difficult. Inventory exists to protect businesses from uncertainty. But the same inventory that protects against stockouts can also become excess inventory when forecasts are wrong. That's the fundamental challenge of inventory management.
Too little inventory disappoints customers. Too much inventory wastes money. And every company is constantly trying to find the balance between the two. The reality is that inventory management isn't about being right. It's about being less wrong than everyone else. And that's much harder than it sounds. If you enjoyed this breakdown of how companies actually work behind the scenes, consider subscribing for more videos on supply chains, forecasting, business systems, and operations explained in simple terms.